Warren Buffett is famous for saying, Rule no. 1. Never lose money. Rule no. 2. Never forget Rule no. 1. But what does this really mean when you pick stocks? You see, Buffett's first rule is about protecting your investment capital. Losing money means you have less to grow in the future. That's why he looks for companies with stable earnings and strong balance sheets. For example, Berkshire Hathaway, Buffett's company, owns Apple. It's a business worth over $2.5 trillion in 2025. Apple's steady cash flow and massive profits make it a low-risk investment in Buffett. He avoids companies with unpredictable earnings or huge debt loads because they increase the chance of losing money. For instance, some startups might look exciting but can lose money for years. His second rule reminds investors to never forget the importance of preserving capital. This means carefully researching every investment, understanding risks, and only buying companies with a margin of safety. Buffett once said, "It is better to buy a wonderful company at a fair price than a fair company at a wonderful price." So, always ask yourself, does this company have a durable competitive advantage? Is it financially strong? Can it survive tough times? If yes, you're likely following Buffett's rules, protecting your money and investing smartly. Now let's look at how we can apply these rules to our own investing journey. First, we need to understand the basics of these rules. The first rule is about minimizing risk. Before you invest in anything, assess the potential for losing money. Consider factors like the company's financial stability, the overall market conditions, and your own investment goals. For example, if a company has been consistently profitable in the past, it's more likely to survive in the future. Similarly, if the market is in a downturn, it's best to be cautious and avoid risky investments. Remember, the stock market is unpredictable, and there will always be some level of risk involved in any investment. However, by following this rule, we can significantly reduce the chances of losing money and protect our investment capital. The second rule is about not forgetting the first rule. Many investors get caught up in the excitement of the stock market and forget the importance of risk management. They take on more risk than they can handle or invest in companies without doing proper research. As a result, they end up losing money. To avoid this, it's important to stay focused and remember the first rule even when things get tough. Set realistic expectations and be prepared to weather any storms that come your way. By doing so, you can keep your emotions in check and make rational investment decisions. In conclusion, Warren Buffett's rules are simple but powerful. By following them, you can minimize the risk of losing money and protect your investment capital. Don't forget to stay focused and keep your emotions in check. Remember, investing is a journey, not a sprint. So take your time, do your research, and invest wisely. If you want to learn more about investing, stay tuned for more videos. Happy investing!